All right, let's dive right into this. Welcome to our explainer today. We are looking at a massive, seismic shift happening right now in the financial world. We're transitioning from an era where artificial intelligence was basically just a passive research buddy into a totally new era where AI becomes an active, autonomous financial operator. So if you think AI is just here to help you, write emails or summarize long articles, you really need to recalibrate your expectations, especially when it comes to your money.
I want you to picture this scenario. Imagine waking up tomorrow morning, grabbing your cup of coffee, and checking your phone, only to discover that an AI agent has been actively managing your entire investment portfolio overnight. While you were fast asleep, completely detached from the markets, an autonomous system was just hard at work. And the craziest part of the whole shebang? You didn't have to lift a single finger or manually place a trade to make it happen. This is literally the ultimate investor's dream, and it is way closer to reality than almost anyone realizes.
Because while you slept, this agent wasn't just sitting idle on standby. It was scanning breaking news across the globe. It monitored late-night earnings reports. It actively harvested tax losses to optimize your returns. And it automatically adjusted your portfolio's exposure to sudden market volatility. This isn't some distant science fiction concept anymore. We are talking about a highly technical set of maneuvers that firms are actively building into their systems right now. Now, we do need to draw a sharp line in the sand between where we are today and where we're going. We're moving away from what we can call AI 1.0. That's the era of asking an AI which stocks to buy or having it summarize a company's balance sheet. Instead, we are entering AI 2.0, agentic execution. We're crossing a boundary from AI that just gives you a neat idea to AI that actually takes autonomous action on your behalf. To really understand how this works, let's look at a real-world user onboarding situation. Take a 45-year-old user. Let's call him Devin. Devin opens the app and inputs his life circumstances. He notes he has 3 kids, and he defines his exact risk tolerance. Then, he sets his goals. He tells the AI he wants real-time tax loss harvesting, real-time rebalancing, and options overlays to generate some income. Once that highly personalized profile is built, step 3 happens. The AI simply goes out and executes the strategy. Right, so that brings us to the co-pilot era, where AI informs, but the human decides. Let me tell you about Obi. He's a retail investor who didn't even wait for a firm to build an agent for him. He just built one himself. He generated a prompt using ChatGPT and plugged it into Claude, essentially telling the AI, act as a hedge fund analyst to find undervalued stocks. He gave it a specific dollar budget and asked it to organize opportunities and find options plays with very specific strike prices. Now here is the absolute kicker. Obi's trick actually made him money. But he didn't just let the code run wild. He maintained incredibly strict risk calibration. He reviewed every single recommendation and made every trading decision himself. He executed the option contracts that the AI pointed him towards, but only after applying his own human discernment. Because as Obi points out, the AI is a fantastic tool, but it is not a replacement. You still need to be there to manually approve the risk.
And this dynamic brilliantly illustrates exactly what startups are building for retail investors today. Take Podium Markets and their AI agent, Ivy. Ivy can look across all your different brokerage accounts, analyze your overall portfolio, and tailor responses based on your personal risk calibration. But Ivy is not algorithmic. Ivy has full visibility into your accounts but zero execution power. The AI informs you of the best moves, but ultimately you, the user, must approve the strategy and place the trade yourself.
But of course, we have to talk about the danger of autonomy. What actually happens when the code fails?
To really grasp the stakes here, get this. Consider the story of a developer who actually built an agent development and orchestration platform. We aren't talking about an amateur. This is someone who used to work for a family office based in Switzerland and Singapore. He saw firsthand how professional trading operates. Armed with all this knowledge, he decided to run a fully automated trading experiment with just $200. And, well, spoiler alert, it did not end well.
Yep, despite his professional background and deep understanding of how to build these agents, the automated system failed. He noted there was this brief period where he made money for almost a week, but that vanished fast. He actually said, "I was just losing money consistently. I realized this is a sinking ship." It's a pretty stark reminder that if you are relying on an AI agent for fully automated trading, you desperately need a professional environment optimized to handle it. So this highlights a massive analytical challenge in the AI space. How do you translate a human goal into a set of precise, safe investing instructions? If you tell an AI, hey, grow my portfolio aggressively, what does that actually mean to a machine? It's incredibly difficult to translate a vague human emotion or desire into safe, executable code.
Because to an AI, the word aggressive could literally mean a dozen different, potentially disastrous things. Does it mean taking on more market volatility? Does it mean taking all your money and building a highly concentrated portfolio in just one or two risky tech stocks? Does it mean utilizing complex options trading that you might not even understand? Just one misinterpretation of your vague instructions could lead to absolute financial disaster.
Which is exactly why the industry is establishing strict boundaries, building necessary guardrails through what's called a regulatory wrapper.
Take the brokerage public, for instance. Let's look at how they build a safe environment for the user. They are building AI agents in-house, but they're doing it with a very specific, restrictive workflow. Step 1. The AI agent proposes an investment workflow to help execute your ideas. Step 2. You, the user, review those ideas and see exactly what the workflow would entail. And Step 3. You approve it and set it up. The AI never has a mind of its own. You always keep the last word.
And there is a very real, very pragmatic institutional reason for this cautious approach. Brokerage firms are legally responsible for delivering this regulatory wrapper for the customer. They have to ensure that your best interests are at the absolute forefront. If an AI suddenly behaves unexpectedly or does something unprompted, that becomes a massive liability for the firm. They literally cannot afford to let the code fail and break compliance.
Okay, so zooming out a bit, let's look at the agentic economy and the rise of the holistic family office.
This timeline lays out the definitive roadmap of where AI investing is evolving over the next few years, once we leave this low-risk experimental phase behind. Phase 1 was the science project phase. Connecting a broker's account to OpenAI just to tinker around. Phase 2 is where we're entering right now. AI agents living in your portfolio as a co-pilot, using real money. But Phase 3? That's the ultimate destination. Moving beyond just execution and into actual advice, effectively operating as a full-fledged financial advisor.
The end game being described here, it's honestly astonishing. It's the concept that everyone will effectively have their own customized family office working for them 24/7. This financial operating system won't just manage your investing sleeve. It's going to look at your broader life. It will optimize your overall asset placement, actively pay your kids' college tuitions, and handle your mortgage payments while you sleep. It literally manages your entire life's wealth around the clock.
But here's the thing you gotta keep in mind. Your personal AI family office isn't going to be operating in a vacuum. We are moving toward a totally integrated agentic economy. That means retail agents, corporate agents, and massive institutional agents will all exist in the exact same marketplace. They'll be interacting and executing strategies simultaneously. Your personal bot is going to be constantly navigating a market filled with these giant corporate bots.
Which leaves us with a pretty massive, provocative question to wrap up our explainer today. As this technology scales up and we fully enter this agentic economy over the next few years, when your personal AI agent starts actively trading against Wall Street's institutional AI agents, who really has the edge? The risks and the rewards here are completely unprecedented, and it's a dynamic we are going to be watching very, very closely.